Hi, I'm Glenn Tompkins. When you're house hunting, the advertised interest rate on a mortgage can be incredibly tempting. But here's the truth, that rate is often just the starting point. Behind the scenes, there's a whole ecosystem of factors that determine what you actually pay. If you want to get the best deal, you need to understand how banks view you as a borrower. So let's break down the main risks that lenders look at. First up, we have repayment or credit risk. Essentially, the lender is asking, what is the likelihood that this person won't pay me back? Your credit score is the primary answer to that question. A strong score shows that you've historically been reliable with debt, which lowers the lender's risk and can score you a lower interest rate. And here's something that seems a bit counterintuitive. Your down payment strategy, it matters. If your mortgage is more than 80% of your home's value, you're required to buy mortgage default insurance. While that sounds like an extra expense, it actually protects the lender if you default. And because that risk is offloaded, you might actually land a lower interest rate compared to someone with a larger down payment who skips the insurance. Next, let's talk about the interest rate in Canada. Many mortgages are renegotiated every 5 years, but terms can range from as short as 6 months to as long as 10 years. Think of this as your exposure to the market. The shorter your term, the more often you have to face the current interest rate environment. If rates rise when your term is up, your costs go up. If you prefer the comfort of knowing exactly what your payments will be for a long time, you can lock in for a longer term. Finally, there's prepayment risk. This is all about the lender's potential lost profit. If you pay off your mortgage early, they lose out on the interest they were counting on, especially if rates have dropped since you started your loan. That's why we have two main mortgage buckets. Open mortgages. These give you the freedom to pay off your loan early, anytime, without penalties, because this is flexible for you. The lender usually charges a higher interest rate to cover the lost long term profit. Closed mortgages. These restrict how much you can prepay, but because this offers the lender more security, they can usually offer you a lower interest rate. So, what's the big takeaway? Don't settle for the first rate you see. Your financial profile is unique to you, and lenders, whether they are big national banks, regional credit unions, or specialized financing companies, all calculate these risks differently. Do your homework. Be ready to negotiate and remember, you have choices. Taking the time to understand these factors can save you significant money over the life of your mortgage. Thanks for watching and have a great day. I'm Glenn Tompkins from Sutton Group Select Realty.